What's up, ladies and gentlemen? It's your man's the Trucking Trader, and we are back with another legendary video. Make sure before we get into this one, make sure y'all drop a like, subscribe to the channel, leave a comment down below if y'all have any thoughts on anything that I can do better, or if there's any trading topics that y'all want me to cover. Let's get straight into this video. So in this video, the thing I'm going to be talking about for beginner day traders is market structure, liquidity, and what moves the market, right? How to find trades. So let's get straight into this video. We are currently looking at the daily chart, all right? And when you're looking at the higher time frames, you really do not need to go back too far. You know, you don't have to go back, 3 months or 2 months out. Typically, I like to just try to stay inside of a range, right? So you guys hear me talk about ranges all the time in videos. And when you're finding a range, the first thing you want to look for is a swing low and a swing high, right? So this right here is a swing low, and this up here is a swing high, right? So that is our range. That's what I'm going to be looking at. There's no reason for me to go like any further. For example, right? Let's say I use this swing low all the way down here. There's no reason for me to be looking that far back because the market typically doesn't move that fast, right? It's probably going to take a long time for the market to actually come back down to these price levels, right? If ever. So I'm going to stay on this swing low to this swing high, right? So that's the first thing we do. We want to identify our range, okay? Now I'm going to give you guys a nice tip right here, and this is something that I do not hear traders talking about that much, right? When the market is moving up this fast, right? Notice how these big green candles happen back to back to back, right? 3 days of just straight going up. When the market is moving that fast, it is typically best to try not to trade that market. And here's why, right? It's going to be so much harder to find anything that really qualifies a really good trade. Even though the market is going straight up, you might be thinking, oh, I could just get in there and buy and I should be good. To me, that is gambling, all right? So the next thing I want to show y'all on a 4-hour chart, we're gonna take a look at this 4-hour chart, right? The next thing you want to do is after you find your range, you want to wait for a market structure shift. And what does that look like, right? So typically, I'm gonna show you guys with one of these tools, right? So it will look something like this, right? We make a swing low, then the market pulls all the way back up, make a swing high, then the market creates a low, right? Now, what you want to see is this pattern right here. You want to see the market come back up here. It could either, sweep this high, or it can stop or it can stop before that high. But either way, what you want to be looking for is a shift like this, right? You want to see the market close like that. Essentially, the shift happens right about here, right? Right at that little line, right? That was your swing low. And then the price came down and closed below that, right? And then essentially what you're going to be looking for when you use your fib is this right here. You're going to put your fib from the low to high, all right? And when you're using the fib, you always start from left to right, always. You're never going from right to left. Always left to right, right? It don't matter if you was going from swing high to swing low or swing low to swing high. You're always going from left to right, right? So typically, this is how the market moves, right? Now, when this market structure shift happens, what you're then going to wait for is a pullback, right? A pullback within this range, right? So you have a range within a range, okay? So actually, let's just remove this off of our chart, right? So that yellow line that's on my chart, that's the 50% level on my Fibonacci. Essentially, all of that is just me measuring out my range, and from the top to bottom or bottom to the top, that's half of my range, right? And you guys hear me talk about this all the time. The top of that range is premium, right? So all of this up here will be premium, right? I'm going to make that red because I want you guys to think of it as selling opportunities happen here, right? In the last video that I made, I used the analogy of, if you own a business, you always want to sell your products for premium prices, right? And if you're a buyer, let's say you're going to a business and you're looking to buy somebody products, you want to buy it at a discounted price, right? So the top of that range is going to always be the premium, and the bottom is going to always be discount, right? So this is what you're going to do step by step. I hope y'all got y'all notebook out, because it's so many gems. I mean, this is literally all you have to do to become a successful trader, right? So now I'm going to take this fib off of my chart, right? So now when the market comes down here and it breaks that low and it creates a swing high, you're going to use another fib, right, from this high up here down to this swing low, right? And you're going to look for something that's above the 50% level on this new range that's created, not forgetting the overall range that you're in, right? Because when you're finding, and this is something that confused me so much when I was a beginner day trader, using the Fibonacci was completely confusing to me, because I was like, well, what range do I use? Well, overall, you're going to always refer to the bigger range. But you have to, in order to get like really precise entries, you want to also know how to look at these smaller ranges as well, right? So when the price comes here, right, we just made a market structure shift. So on a daily, we're uptrending, right? But on a 4 hour, we just made a market structure shift. And now we're going to wait for the price to pull back up in here, right? And then right here, somewhere in there, it may be an order block or something like that. We're going to take a sell position, and then we're going to sell this all the way down back into the discount zone, right? That's essentially what we're looking for every time, right? And now I'm going to show you guys how this looks on an actual chart, okay? So I'm going to delete all of this stuff, and I'm going to show you guys how this looks on an actual chart. This is all you need to become a successful trader, right? So we're on a 4 hour time frame. Now, there's two things that move the markets: liquidity and gaps in the markets, okay? Now, I'm going to first show you guys what a gap in the market looks like. Gaps are normally 3 candle patterns, right? So, for example, we have a gap in the market right here. We have 1 candle right here. We have 2 candles, and then we have 3 candles, right? Now, pay attention to this candle. The first candle wick right here, and the third candle wick creates what? A little bit of a gap right here. So if I put a line on here so I can show you guys, right? If I use my horizontal line to show you guys the wicks that I'm talking about, it will look something like this, right? That will be the gap in the market, right? Now I'm going to leave that on my chart, because obviously you guys can see right here, the market came right down to this gap, and then it started to bounce, right? Started to have reactions, right? So there's 2 things that move the market: liquidity and gaps in the market. Now, back to the market structure, right? Now, on a 4 hour time frame, what are we looking for? Well, we're looking for a shift of market structure. And for some reason, it looks a bit different on this chart than the chart that I usually use to trade. So let's drop down into the 1 hour time frame and see if we can get a shift on the 1 hour time frame, right? So right here, notice, right here, this low right here gave us a shift on the 1 hour time frame, right? And the reason why it gave us that shift is because these candles right here close below these swing lows that's over here. Notice how you have to see the body of the candle close below a swing low or a swing high in order to consider it as a market structure shift. Notice how when the price came down here the first time, it just wicked this and then it went right back up. That is not a market structure shift. That is what we call a liquidity run, okay? So after we got our shift in the market, now what do? The same thing that I just did on that example that I was showing you guys, right? We use our Fibonacci tool. We place the fib from high to low, right? We're going to use this low. Now notice we have our premium and we have our discount zone, right? We have our premium and we have our discount. Matter of fact, let me box it up because I want to make sure y'all know exactly what I'm talking about. Okay? So this red area up here is premium. Remember, Premium always favors sellers. You should not be buying inside of a premium zone. Discount always favors buyers. Okay, you should not be selling in a discount zone. All right. Now, so we have our premium, we have our discount, right? So I just wanted y'all to see it. I'm not going to leave it on the chart because I don't want anybody to get confused. Okay. So now, okay, I'm going to scratch this fib out. Remember, the yellow line is my 50% level, which essentially means from swing low to swing high, that is half of the range. That's all I use the Fibonacci tools for. I do not use the Fibonacci tools for trading or entries or anything like that, even though you can use them for those type of things, right? But I'm not teaching that right now. Okay, so I'm going to remove this fib off of my chart. And then what are we going to look for when the market breaks structure? We're going to look for a pullback back into the discount zones. Okay, what moves the market? Liquidity and gaps in the market. Okay, so that's what you're going to be learning how to identify. Now right here, these swing highs right here, this is liquidity, right? And liquidity is essentially where the stops is going to be resting, right? Retail traders always put their stop losses right above swing highs or right below swing lows, right? So the market knows that, and the market is going to go back up there and take those guys out every time. Okay, now notice this right here. What else do we have in here? We have a gap in the market. Okay, right here, this right here, we have a gap in the market. I'm going to zoom in for y'all. Okay, now same thing, right? It's a 3-candle pattern. I'm going to put my line on that first candle wick, and I'm going to put my line on the third candle wick. The second candle is always where the gap is going to be at, right? And boom, just like that, you get into this trade, right? Because every time you get into a trade, you want to see a liquidity run every time you get into the trade. If you do not see a liquidity run every time you get into the trade, you should not be taking that trade. Okay? Let me repeat that one more time. Every time you take a trade, you should be looking for a liquidity run in the market. And if you do not see a liquidity run, you should not be taking that trade. Okay, so when you using these fair value gaps, the way ICT teaches is this, right? Your stop loss is going to go maybe like 5 or 10 points above this wick, or 5 or 10 points above this wick. Me personally, I always use the highest wick all the time without fail. I do not switch it up. I don't care if it's a 50-point stop loss. I don't care if it's a 60-point stop loss. That's where the stop loss has to go. You have to manage your risk based on the rules that was set, okay? So when the market gets in here and you take your trade, this is how you're going to frame it. The trade should look like this, okay? You get in. I always at least try to look for the midpoint of the fair value gap or order block. Okay, and then I'm going to put my stop loss right here. And then this is where you need to always remember to refer to the bigger range, right? This is why doing the top-down analysis is so important, because how do you find your target? Well, you find your targets on a bigger range, right? Remember, the two things move the market: liquidity and what else? Look, gaps in the market. Okay, so now that you entered the trade and you're thinking to yourself, okay, where do I get out? Well, you always want to refer to the bigger ranges. Okay, I'm telling you guys right now, this is all you need to become a successful trader. If you can master these steps right now, I'm just trying to tell you guys, I wish I knew about this years ago when I first started trading. I spent too many years losing just because, I was looking at all of these fancy things, indicators, EMAs, all of this stuff. I don't use any of that stuff. All I do every day is exactly what I'm showing y'all right here. So when you get in that trade, we're going to go back to the hourly time frame. Okay, when you get in that trade, this is how it's going to look. You're going to set your stop loss, and your TP will be either right here, right at the equilibrium area, or you can target the gap that's in the market. Notice those blue lines is the gap in the market. Now, if you're going to target the gap in the market, here's another tip. Always do not target all the way down here, right? Do not try to target in the middle. Put it right above, like 10 or 20 points right above, just in case, because sometimes the market will go to these areas and it will just stop and it will start to retrace, and then it will turn you into liquidity, and that's not what you want, right? So that's how you end up getting these high risk to reward trades that's really precise, right? So pay attention to the steps that I just gave you guys. You got to identify a range, okay, on a higher time frame. Do not go to the 1 minute time frame talking about some, oh, I have a range on the 1 minute, or don't even go to the 15 minute. Do not go to the 30 minute. At the bare minimum, you need to be on a 1 hour, 4 hour, or the daily chart. That is, I just can't even stress how important that is. Don't go to the 15 minute doing stuff like this. Oh, look, this is swing low. Oh, swing high. Wow. He said discount. So I bought right here. I'm a genius. Don't do that. Why? Because even if it works a couple times, more times than not, you're going to just end up losing, and then you're just going to find yourself in stressful situations for absolutely no reason at all. Okay? So use these higher time frames. Me personally, I like to stay on the 4 hour, and I like to stay on the 1 hour, right? And I like to refer to the daily. Literally everything I just showed you guys in this video is what I do every time I take a trade. Play this video back, study it as much as possible. I tried to make it really short and sweet for you guys because, you know, I'm noticing that that's the type of content people like. They like 10-minute, 15-minute videos. However, I can't fully break this stuff down in a 10, 15-minute video. But I'm going to, you know, make these type of videos for newer traders because, you know, when you're a new trader, this type of stuff has to be spoon-fed to you. A lot of you guys, if you don't know what liquidity is, if you don't know what a fair value gap is, you probably don't even know what I'm talking about. And if that is you, this is my recommendation. Go to the Inner Circle Trader YouTube channel and start studying. All of the information is there. I'm not trying to hide anything from you guys. Go to the Inner Circle Trader, study. I was just watching a trader, a well-known trader, do a breakdown on his charts, and he was teaching his trading strategy. I'm not going to lie, it was horrible. I thought it was a horrible strategy. It was too much complication, and he did not give enough details on his strategy. So if you guys like exactly what I'm talking about, leave a like on this video, subscribe to the channel, and comment down below if there's something you do not understand and you want me to make more videos on it. Leave a comment down below. That's what I'm here for. I'm trying to help out as many beginning traders as I can, because I remember when I first started trading, it was a headache, and it was mostly a headache because I was put in front of the wrong information.